Hey everyone, welcome back to Corporate Decoder, the place where we crack open the financial secrets of the business world, and boy do we have a juicy one for you today. This isn't your average corporate filing, it is a deep dive into the Abrdn Global Dynamic Dividend Fund's latest registration statement. We're going to pull back the curtain on how they plan to make money, their strategies, and yes, we'll even look at the numbers that really matter. Before we dive in, if you want more of these unfiltered looks into corporate filings, make sure you're subscribed and ring that notification bell. And hey, we've got a fantastic community over on Discord, so join us there for more discussions linked in the description below. Alright, let's get straight into it. This document, filed back in October 2025, is essentially a prospectus, which is like a detailed brochure for investors. It is telling you all about the Abrdn Global Dynamic Dividend Fund. Think of it as the fund laying out its game plan to attract your investment dollars. The fund's main goal is pretty straightforward: to give you high dividend income that ideally gets taxed at your lower income tax rate. Think of it as income that is more friendly to your wallet. As a nice bonus, they also aim for long-term growth of your capital, meaning they want your investment to grow in value over time. Now, how do they plan to achieve this? They invest in companies that pay dividends, and they not shy about it. They aim to invest at least 80% of their assets in companies that pay dividends, both from the United States and abroad. They're looking globally for companies that offer good dividend yields and have the potential for their stock price to go up. They even employ something called a dividend capture strategy. This is where they might sell a stock shortly after it pays a dividend and then use that money to buy another stock that is about to pay a dividend. The idea is to get more dividend payments over time than if you just held onto one stock. Pretty clever, right? If it works. They're looking to raise up to $150 million, which is a substantial amount of money. This capital will be used to invest according to their strategy. They might offer common shares, preferred shares, or even notes. Let's talk about the cost of investing. This is always a crucial part. You'll see a breakdown of fees. The advisory fee, essentially what the fund managers get paid, is 1.00% of the fund. S assets, that means for every $1,000 you invest, they're taking $10 a year. Then there are other expenses, and when you add it all up, the total annual expenses come out to about 1.35% of the net assets. This might sound small, but over the long run, these fees can really eat into your returns. If you participate in their dividend reinvestment plan, there are some small per share fees for managing those trades, but they've tried to keep those quite low, like 2 cents per share for open market purchases. For optional share purchases, there are small fees for automatic debits or checks. They're trying to make it convenient, but these little fees add up. Now, for the part that really shows you the impact of those fees, they show an example of what you pay on a $1,000 investment. Assuming a hypothetical 5% annual return, in 1 year, you pay about $14 in fees. Over 10 years, that is $162. This doesn't even include any sales loads or offering costs, which could be extra. It highlights how important it is to understand the fee structure before you invest. Let's dive into the actual performance numbers. This table shows you how they've been doing for the 6-month period ending the 30th of April, 2025, the net asset value, or NAV. Per S started at $11.15 and ended at $10.5. This indicates a bit of a dip in the value of the fund itself. However, the market price, which is what you actually pay for the shares on the stock exchange, ended at $9.99. That is a discount to the NAV. Looking at the market price at the end of different periods, in 2024, the market price was $10.16 and the NAV was $11.15, meaning you could buy it for less than its underlying value. In 2023, the market price was even lower at $8.4 while the NAV was $9.9. This is typical for closed-end funds. They can trade at a discount to their NAV. The fund actually has a program to buy back its own shares to try and reduce this discount. They also use leverage, meaning they borrow money with a line of credit to invest more. As of the 30th of April 2025, they had about $18.4 million outstanding on their credit facility. The asset coverage ratio, which is basically a measure of how much the fund S assets cover its debts, was 1,530%. That sounds high, but it means for every dollar of debt, they have about $15 in assets to cover it. This ratio has been much higher in prior years, sometimes over 50,000%, meaning very little debt compared to assets. However, the figures show they've been using more of their credit line recently. For instance, in 2023, their outstanding balance was only about $1.5 million, and their coverage ratio was over 16,000%. So they increased their borrowing. This section on senior securities clarifies things. It shows their borrowings which are considered senior securities. As of the 30th of April, 2025, the outstanding amount was $18,356,000. The asset coverage ratio was 1,530%. This again confirms they are using leverage, and the amount under their credit facility has varied significantly over the years, peaking in 2019, and then coming down and now increasing again as of 2025. The Fund S common shares are listed on the New York Stock Exchange under the ticker symbol ABRD. Interestingly, as of the 6th of October 2025, the net asset value per S share was $11.75, but the market price was $13.75. That is a premium of over 17%. So, in this instance, investors were actually willing to pay more than the underlying value of the Fund S assets. This premium is separate from the risk of the NAV decreasing, so it is something to keep an eye on whether that premium holds or shrinks. They mentioned that their investment objectives and some policies are fundamental and cannot be changed without shareholder approval. This is important for investors as it means the core strategy is protected. Now, every investment has risks, and this fund is no exception. They warn that an investment in the fund is subject to investment risk, including the possible loss of your entire investment. They also point to a section in their annual report for more detailed risk factors. Generally, investing in dividend stocks, especially with leverage, can be more volatile. Let S touch on taxes. The fund aims to be a regulated investment company, or RIC, which generally means it doesn't pay taxes on income it distributes to shareholders. This is good for tax efficiency. However, distributions of ordinary income and short-term capital gains are usually taxed as ordinary income to shareholders. Distributions of long-term capital gains are taxed at lower rates. For non-US shareholders, there is a 30% withholding tax on dividends, which can be different if there is a tax treaty. The fund managers, not the shareholders directly, vote on proxy stows or votes on company matters at shareholder meetings. The filing details their approach to voting, emphasizing what they believe is in the best interest of clients, considering factors like governance, environmental, and social issues. They use external services like ISS to help with recommendations. Digging a bit deeper into their investment philosophy, they have detailed proxy voting guidelines. They're looking at things like board composition, ensuring a mix of skills and independence. They also consider executive remuneration, ensuring it is aligned with company performance. They have specific policies on environmental, social, and governance factors, or ESG, across different regions. It shows they're trying to be responsible owners of the companies they invest in. Finally, the filing includes a table of costs related to this registration. Think of it as the paperwork fees. These are estimated expenses for things like SEC registration, legal fees, and accounting. For this filing, the total estimated expenses were around $190,000. So, what is our take on the Abrdn Global Dynamic Dividend Fund based on this filing? On the positive side, they have a clear objective focused on dividend income and capital growth, with a defined strategy of investing globally in dividend-paying companies. Their use of a dividend capture strategy is interesting, and they are actively trying to manage discounts to NAV through share repurchases. The ESG focus in their proxy voting shows a commitment to responsible investing. However, there are risks to consider. The fund uses leverage, and while the asset coverage ratios appear high, the recent increase in borrowing and the resulting lower coverage compared to previous years warrants attention. The fees, though not exorbitant, are a consistent drag on returns over the long term. Also, the fact that their common shares can trade at a premium to NAV as seen in October 2025 means investors might be overpaying for the underlying assets at times. Overall, this is a fund that aims for income and growth through dividends, utilizing global equity investments and leverage. Investors should carefully consider the fund SV structure, its use of leverage, and the potential for its shares to trade at a discount or premium to NAV. It seems like a solid strategy for income seeking investors, but like all investments, it comes with its own set of risks that need to be understood. Alright, that is our deep dive into the Abrdn Global Dynamic Dividend Fund S registration statement. What are your thoughts on their strategy and these numbers? Let us know in the comments below. If you found this analysis valuable, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our community on Discord. The link is in the description. Thanks for watching, and we LL see you next time on Corporate Decoder.